insurance. This is Tony Cañas. I had a very interesting chat this week on Chat with Tony that I want to title 4,000 Books Would Have Saved Him. Basically, it went something like this. I had a call, Chat with Tony, with a manager at an insurance carrier. This manager was telling me the story of one of his employees. He was surprised that one of his young employees had put in a 2-week notice. And this young employee, let's call him John, was a young hypo employee who had been with the company only 3 years, had started with the company right out of college. The reason that his manager, let's call him Mike, that Mike was telling me the story and concerned about it was that John was widely seen in the company by his manager and the manager's leadership above him as a person who they wanted to grow, who was likely to have a great future within the company. So they were very surprised when John came in with a 2-week notice. They asked him where he was going, and he's going to a competitor. They asked if there was anything they could do to keep him. John said, well, I'm getting a $20,000 raise to make this move, right? A significant raise, like a 40% raise for somebody that came into the industry only 3 years before, right out of college. At this point, it was too late, probably too expensive to do a counteroffer. Counteroffers are almost never a good idea. I'll make a video on those. But either way, it was too late, right? There was no way to bend the budget enough to get him a 40% raise to keep him. And even then, who knows if he would have accepted it. So this is a story that I hear often. The part that I found very interesting was the next comment from the person that called me. Let's call him Mike. So Mike says, 4,000 books would have saved. I asked him to explain that. I'm like, well, he's leaving for 20. How do you think 4,000 would have saved him if the offer he got was 20 higher? And basically what he said is that he's pretty sure that John was happy in his position, that he was happy with the company, that he was actively recruited. He didn't go applying for a different job. He was actively recruited by a third-party recruiter. Had they been able to give him something as simple as a $4,000 raise this year, right? And this year, 2020 is a hard year. Raises have been frozen for this particular company. That makes it harder, and in a normal year he wouldn't have gotten a $4,000 raise. He would have gotten a cost of living raise, right? So he would have gotten something smaller than 4,000. Even if raises hadn't been frozen this year, this probably still would have happened. So basically what he was saying, what Mike was saying is, if I could having known high potential employee who we really want to grow here, had I known that he was going to get recruited away, I'm pretty sure that a significant raise, a raise that was more than cost of living, that recognized this person's perceived long-term value to the company, would have kept him from taking the call from the third-party recruiter. When the third-party recruiter called, he would have been so sure of his position in the new company that he wouldn't have gotten into the conversation that ended up leading to a $20,000 raise. My thought on this is that he's probably right. And the problem is that insurance companies are generally old. And that's not a bad thing per se. Rob Galbraith, in his excellent book, The End of Insurance as We Know It, published by Insurance Nerds, talks about how in the US, the youngest of the top 10 P&C carriers is Allstate, which is 89 years old right now. So they're going to be 90 next year. That's a very, very old company. And our industry is packed with companies that are that old. Many of those companies, or most of those companies, if not all, were designed, and all the HR systems, etc., were designed for an era of stability, for an era of lifetime employment. In that environment, in the environment of lifetime employment and stability, rewarding loyalty and tenure makes sense, right? So raises tend to be more correlated with tenure than with anything else. Your risk of losing a successful, promising employee only 3 years after he's joined the company are low, because they're not getting constant calls from recruiters offering them a 40% raise, which is an incredibly common thing today, especially in underwriting. For young underwriters, it's an incredibly common thing, especially if they get their CPCU or if they have an RMI major from college, or both of those things are true, which is the case for many of them. In the old environment, it wouldn't make sense to grow this person's salary too quickly, because then they would become too expensive for the company and kind of like damage your budget for the long term. In the increasingly competitive labor market that we find ourselves in, and a labor market where there is no longer a penalty for changing companies early in your career or in the middle of your career, either way, it is imperative to make sure that your people, especially your young, very promising employees, are paid at market or close to market. I'm not saying that you have to every year look at the market value of each of your employees and then get them exactly to that point. No company would be able to afford doing that in a competitive labor market like ours. But what I am saying, some recognition and some movement towards their value in the market, it could go a long way towards keeping your employee from taking my call. Not mine specifically, I'm not a recruiter myself, but I do work for the largest recruiting company within the industry. It would go a long way towards keeping the employee from getting tempted when they do get called by a recruiter. And the key time where I see this happening a lot are those first, let's say, 5 to 6 years in the company. After that, I think there's a lesser risk, because if they've stayed in the company 5 or 6 years, they have probably developed a strong network that within the company. They have probably found their footing, like really found their footing within the company, and it's a little harder to dislodge them. But within the first 2 or 3 years, I think that's the danger zone. Between year 2 and the end of year 2 and the end of year 4, I believe is the danger zone for new employees, because they are likely, if they're investing in themselves, they're likely to see significant growth in skill set. And quite simply, the brand new college grad, RMI major or not, brand new college grad with no insurance experience in the market is probably worth somewhere around 55,000, while that same person plus 2 or 3 years, especially if they've invested in themselves by doing something like getting CPCU, and those 2 or 3 years are something like commercial underwriting or another high value area of insurance where there's a lot of demand for talent, and they've had success there and they've invested in themselves. Now they're easily worth 30-40% above that in the market. And yeah, I understand you can't get them that much of a raise that quickly, but the more that you can do to give them a better than cost of living raise and make it super clear, that's the other piece of it. I think that not only 4K would have saved them, I also think that making it explicit, you have a great future here. This is what we see for you. Make sure that they know where in the plans of the company that they feature, and they know the timelines, at least some idea of the timelines and what they need to do to actually get there. That's gonna go a long way to keeping your young, high potential employees from taking the competing offer. Thank you for listening.